Yeah, look, thanks very much. I wanted to ask you a few questions about the housing system. So, effectively, if you go back 10 years or even 5 years, we were getting more like 200,000 houses a year on average. We got as high as 220,000 new dwellings, I think in 2017. We're looking at about 170,000 this year. Where do you think we're heading on supply?
Well, again, I'm not sure I'm qualified to talk about supply of housing, Senator. All I can say on this is that the government, certainly where I sit in New South Wales, the government is extremely focused on supply. And one of the issues about supply has been regulation and development. Whenever we go out in our liaison programs and we talk particularly developers in New South Wales, they all say it is so difficult to get high density housing through. So my only comment would be that yes, we have a structural undersupply of housing, and we've had it for many years. It's been a chronic underbuild. There's obviously regulation and development, so on, that's getting in the way of this. The government's recognised it. And if you just look at the numbers so far, according to targets, it doesn't look like we're going to get there, quite frankly. But that's not to say that, that the governments haven't focused on it and think it needs to be addressed.
Okay, so you obviously look at the overall housing system and noting that we are not going to get there from a housing target perspective. What impact do these, if any, Commonwealth demand side measures have, do you think, on the pricing, on the prices people are having to pay, noting that we are in a supply constrained environment?
So any policies that add to demand in a supply constrained environment obviously will find its way into prices, Senator. I have no particular insights on amounts. Other people have done their own calculations of those sorts of things, but by definition, yes.
Okay, so in relation to the 5% deposit scheme, last time you appeared at this committee, you said that, I don't want to verbal you, Governor, you said that prices might be a bit higher than otherwise were. I'm not going to ask you the same question, don't worry. I'm sure the answer will be the same. I guess we now have found out that this policy was announced without there being any modelling undertaken by the Treasury. The Treasury's evidence was that they did do modelling, but that modelling occurred after the announcement of the policy. Were you consulted, or was the bank consulted in the process of Treasury doing modelling on this scheme and the price impacts?
I don't believe so.
You don't think you were consulted?
I don't believe so, but I'll take it on notice and I'll ask the relevant people.
Okay. The October data from Cotality and from SQM and others has shown direct links between the 5% deposit scheme coming in and, in their words, adding to higher prices at the entry-level point of the market. Is that something that you agree with? Does your own data stack that up?
Well, we wouldn't do any independent analysis of that. We would usually use Cotality's data.
Okay, so you think Cotality is a reasonable data house?
I think they're a reasonable data house.
Look, I think we've also seen we see the lending data, and that suggests that there were a few extra first-home buyers coming in October once this scheme kicked into being in its new form, and there was what you did notice was a slight increase in the average value of the loans going to first-home buyers. So that's consistent with that. But translating that into a price effect is another thing entirely.
Well, let me come to that, Dr. Kent. Cotality says, I'm going to quote them now for the record, the step up in growth rates also coincides with the expanded 5% deposit guarantee scheme going live on October 1, which is likely added to housing demand, especially around the lower to middle price points of the market, end quote. So it sounds like you think that's a reasonable assessment.
Yeah, we would think that's a reasonable assessment, and I think that's exactly what Chris is saying, that the lending data, although it doesn't go to prices, suggests that that's what's happening. There is a response of first home buyers.
Yeah, so the 5% deposit scheme changes have increased prices in the first month.
Well, what we have seen is, the data I have seen is suggests slightly increased average value of loan going to first home buyers.
That's not the same as price.
It's not the same as the price, but it would be consistent with that story.
Okay, so when you say average balance of the loan, you're talking about a 95% loan?
No, I'm just saying. We can see the number and value of first home buyer loans. The average value of a new loan going to a first home buyer has picked up.
And that could be that there's a higher loan to valuation ratio, or it could be that because there's no cap on the income of the first home buyers now, it could just be that there's some higher income people coming in.
Higher income people coming into the government scheme?
Yes, because the cap on income of the first home buyers was removed.
That's right.
So people who would have been constrained because they earned too much now could come in.
Yeah, so potentially that is then resulting in lower income earners with a higher LVR not being able to use the scheme.
No, they can still use the scheme.
But it might not be possible.
They can still get a loan up to 95% of the valuation of the property.
But it might not be possible under the new macroprudential tools. So have you been consulted on the new APRA macroprudential arrangements?
Yes.
You have been consulted, okay. And what was your input to that informal or behind-the-scenes consultation?
So the way the process works, Senator, is that we provide advice to APRA on the macroprudential environment, the macro-financial environment, potential financial stability risks. We don't tell APRA what to do. We tell them where we see the potential risks arising, and where we would highlight, it was back to an earlier conversation, is increased investor lending. And the concern is that if you end up with increasing riskier lending, and they can find themselves in high loan to valuation ratios or high debt to income ratios. So we advise them that there might be some pressures building. They're not substantial at the moment. And so that's the advice we provide to APRA, and then APRA go away and think how they want to think about that and what they might do.
Okay, and they announced that last week. So,
yes, correct.
So effectively, the position is that if you have a 6 times income to debt ratio, there will be, for owner-occupied or investor, you might find that you can no longer get finance. That's basically the position, isn't it?
Possibly, but the limits are nowhere near binding, Senator. The amount is 20% of the flow, so 20% of loans can go to high debt to income borrowers. So that's 20%, and the limits are nowhere near binding.
So
in aggregate, I think high debt to income lending at the moment is sort of still down the single figures, 6%, something like that.
But you think it's an important measure or not?
I think it's an important measure to have as a guardrail. It's preemptive. It's not binding at the moment, but it just cautions banks that to be careful in their high-risk lending because they will come up against these guardrails. It's a common technique also, or a common policy often used in overseas economies.
Okay. Well, is it a...
You can wind up.
I haven't really finished, so do you want to...
Yeah, so we've
got 5 minutes.
Yeah, if we can keep our questions tight, we'll try and, if you want to finish off, then we've got Senator Sharma and Senator McKim, who's just got 5 minutes. Then I think we can
Okay, I've probably only need 3 minutes. Look, I just finish off what we were talking about before. So in relation to the 95% loans, I mean, maybe it's a dumb question, but is it good to have a lot of these in the system?
They're high loan to valuation ratio loans. There are some of them out there. I think about 5% of loans at the moment are at high loan to valuation ratios. They are risky. But that's why, in the absence of this thing for first home buyers, normally if you take out a high loan to valuation ratio loan, you're expected to have mortgage insurance. And what this does, the government's proposal for first home buyers, is that they don't have to go and buy mortgage lenders insurance. The government effectively guarantees it. They're inherently more risky because, as you would understand, the more you borrow, the higher the loan to valuation ratio, then it doesn't take property prices far to fall before all of a sudden what you're owing is worth more than the asset that's backing it. At the moment, this sort of concept of property prices that are worth less than the loans, there's practically none of them at the moment. I mean, we occasionally have graphs on this in the Financial Stability Review if you're interested, but because of the rise in property prices, practically no one is underwater in terms of their loan to valuation ratios. But the higher the loan to valuation ratio is, yes, the more risk there potentially is in the system.
Okay, well, just finally then, I want to just get you on the record on the mesh between the APRA macroprudential rules and the 5% scheme, because the way I look at it is, well, if APRA is going to reduce the number of these loans by definition, at the same time that the government is pushing these 95% loans, wouldn't it be the case that higher income earners could actually stay in the 5% scheme, but lower income earners with fewer assets, lower incomes, could actually be squeezed out of the program because of the macroprudential rules?
But I come back again to my initial point, Senator, these aren't binding. There's actually headroom for banks, so there's no sense in which APRA's imposed these things and all of a sudden people who thought they could get loans couldn't. The banks have headroom here. It's not binding.